So, lovely venue, and we have some football on Sunday as well, so the stars have all aligned. So not only am I here and going to enjoy myself chatting away here, but I'm going to have a fantastic sort of weekend as well. I was thinking over lunch as I've known Mark 20 odd years. So my background is I did 3 years at the co-op, the CIS, investment stuff. 27 years at the Brookes, so that's kind of like the man and boy kind of thing. And more recently, kind of 6 years at Legal & General, which is more about kind of house building and sort of rebuilding the city. So my kind of portfolio management career was really at the Brookes when I used to chat with Mark. So 20 odd years ago, it was like all the big kind of .com stuff. I don't remember, it was all... you'd have a business with 10, 15 people and no revenues, no profits, and somehow it was kind of worth more than Marks and Spencer's. And it kind of struck us within the team at the Brookes that something kind of quite weird and kind of quite odd was going on. Is this kind of really the way that kind of investment needs to go on? And of course, we're inundated with all the kind of incoming from all the banks and all the stockbrokers going, oh, we're upgrading on this, so you've got to buy someone. GDP growth is going down here, and you've got to do something there. And we just sort of stepped back from that a little bit, and it's kind of, what's kind of going on here? The kind of people that we're speaking to, are they just, do we think they're smarter than everybody else? Do they work longer than anybody else? They got bigger teams, sort of fancier models. And it struck us that it really wasn't a very good approach just to think that all the time you were just a little bit sort of smarter than everybody else, and that each quarter you'd come up with a little bit more that would make your performance just a little bit better than everybody else's, which is the way that it worked. So we got the drains up and went right back to first principles. So this is all kind of like what makes kind of prices move? What's the process of price discovery? Why is, why is Glaxo £17.30? Why is the FTSE 7,300? What causes that? What causes volatility in markets? Why might the market get it wrong? If you do think that the market gets it wrong from time to time, and that's not a no-brainer. There's a big industry out there that says that markets are all efficient and you can't do, there's no point sort of thinking about it because everything's in the price. But if you do think that from time to time the market gets it wrong, how do you organize yourself to kind of take advantage of that? So we're in the midst of all this stuff, thinking about all this. And a lot of what we kind of like focused on, having observed that markets kind of bounce around an awful lot more than what seems to go on in the real world, something else must be kind of going on in terms of causing that volatility. And we kind of came to the conclusion that it was us, it was people that was doing that. So there's something about the way that kind of people respond to information, emotionally, the kind of behavioral biases that they've got cause a lot of this kind of excess volatility. And that took us into a whole load of literature and read, and Mark knows all this stuff, the Kahneman and Tversky and Bob Schiller. If you get on the subject of black swans with Mark, I'm sure you'll have a good night's sleep. He's very, very knowledgeable. So we thought about all this, and of course Mark was very like-minded. We were, kind of quite arrogant, to be honest, at that time, but Mark was one of the very few people that would come in and we would talk to, and we would have kind of conversations about this, kind of what makes people tick and kind of where might mispricings be kind of going on in the market. So I was very pleased. So Mark has not told me what to say. So he's just kind of come along and sort of chat about stuff. It's kind of investing for the future. And that kind of shows kind of a lot of trust, and I appreciate that. But it is well placed. We are kind of very aligned, if you like, in terms of the way that we think about things. Windmills, I'll come on to windmills in a minute. So this is footballing analogy. So this is a game of two halves. So the first bit, I'm going to kind of reflect on that kind of 36 years and just say, these are the kinds of principles or the kind of rules that I think should organize the way that you think about investment. Right? This isn't, it's not like a black box, it's not rocket science, there's nothing kind of fancy. This is just basically what kind of framework maximizes the chance of doing well. Right? It doesn't guarantee anything, but to my mind, given what I've seen and the way that people behave, this maximizes the likelihood of it going well. So that's the first bit. And the second bit is I have had a big interest in all things to do with climate change for quite a long time, a lot longer than Greta. So back in Kyoto, I think, was the one that I remember, is 1997. So I wrote my first note on climate change for the Pru in the late 90s. And it does seem to me that this as an issue has kind of come more and more up the list of things to worry about. And I think it is potentially kind of quite profound. Either if we do something, there are implications we need to think about, or if we don't do anything, there are implications that we need to think about. And this is just from an investment perspective. Okay, I'm not kind of a big evangelist for all this kind of stuff, that you can eat meat and you don't need to buy kind of electric cars. This is just thinking about from an investment perspective what's going on. And I do think it's a big deal. But my one broad observation is I think that the debate about kind of whether or not it's happening, I think, is over. Right? If you dispute that, then we can have a chat kind of later on over dinner. But I think that the science is true. It's now, do we want to do anything about it? And if so, what? And there are huge kind of implications in terms of the market is concerned of going down one route or the other. So these are my broad framework. And I did say kind of wasn't rocket science. So be humble. And this is my strongest observation over the last kind of 36 years is that most mistakes are made because people are kind of overconfident. And I said people there, it's actually men. Because most of kind of investors kind of tend to be men. And a lot of the stuff that I've read that kind of compares in terms of behaviors, how women behave and respond to information compared to men, they generally, men are a lot worse in terms of basically refusing to accept that they're wrong. And that has huge implications in terms of kind of managing a portfolio. And it's absolutely true. It's absolutely true. And overconfidence causes two things. One is you end up with positions or bets in the portfolio that are far too big, because you really believe this stock or you really believe this story, and what should really be kind of like a 1 or 2% holding becomes a 10 or 15% holding. And unless you have absolutely kind of great skill, and I've yet to see it, at some point that's going to go wrong. And the other problem with being overconfident is that you tend to overtrade. And even if you have skills, even if you're good at it, and being good at it is probably getting it right about 51% of the time, even if you're doing that, the costs connected with actively trading in terms of spreads and commissions and stamp duty and all the rest of it, it's like swimming against the tide. It's just very, very difficult to capture additional performance from regular trading. So be humble. There are two things that follow from that, and I just want to talk about, because I have a real kind of bugbear with all things to do with forecasting. And I don't want to here to be kind of especially kind of disrespectful to kind of economists and strategists. But there's a particular kind of forecasting, which is about 80, 90% of the stuff that I see, that is simply just kind of extrapolating from what happened from the year before. So, the company delivered 10% last year, so, it'll deliver 10% next year and then 10% the year after. Or, country's GDP has typically grown between sort of 1.5%, 2%, so that's my forecast for the next year. Ditto with inflation. And you know what? For the most part, because the world that it is doesn't actually change that quickly over short periods of time, those forecasts are kind of broadly okay. But there is no information content in them whatsoever. Because what you really want to know is when the future is not like the past and when there's a problem. You really need people to focus on kind of risk and thinking about kind of the distribution of risk and the distribution of outcomes, not just doing kind of like point forecasts about what the future is going to be like depending on the last. Because of course what happens then is you'll get the year when everything does change and all those correlations and volatilities that have driven this is what I think is going to happen next year, it all goes horribly wrong, and you call back your broker and say, well, that wasn't a very good forecast, was it? Oh, it doesn't matter because everybody else got it wrong, right? It's just most forecasting is an absolute complete pointless exercise. And the other point that I want to make in connection with this kind of sense of kind of overconfidence is that if you're, as I said, reasonably humble and you realize that you've got a limited understanding of how the world is going to pan out, the best thing to do, a good thing to do, is diversify. Now, I saw on the FPC kind of website, I did have a look, and there was an absolutely wonderful phrase that was kind of used. I don't know if it is yours, just right. But so it's the only free lunch. I love that, and I loved it so much that I kind of put it down. Because most of the time, kind of investment, the idea of there isn't a free lunch is to get paid more, to have more return, you need to kind of take more risk. So investing in gilts, you take a bit more risk than investing in cash and you get paid a bit more, or you invest in a corporate bond and you take credit risk and you get paid a bit more, you invest in equity, and so you take more and more risk, you have a greater chance of losing money to get a higher and higher expected return. But with diversification, it is absolutely genuinely a free lunch. And it's absolutely wonderful the way that the maths of kind of the way that correlation works for you. Once you start packaging up assets, you have a bit of this and a bit of that and a bit of that. The way that the maths of the way that is correlated works together dampens down volatility for any kind of particular level of return. So if you say, this is how much risk I want to take, in a diversified portfolio, you can construct something that gives you a better expected return. Or if you just flip that round and you say, this is the return that I want, in a diversified portfolio, you can minimize risk with respect to that. It really works kind of very, very powerfully. When I used to, the with profits, because the Prudential's with profits fund was kind of about 80 billion. Not my money, it was about 80 billion. And of course, with that kind of, you could have massive kind of diversification across the fund. You could own like Blue Water Shopping Centre, which was sort of 700-800 million pounds, and it was still a tiny little bit of the fund. And very often, people would say, you can't be that good a fund manager because you don't really have any views. You just have a little bit of everything. And he said, well, just look at the numbers. The risk-adjusted returns in a very well-diversified fund are absolutely outstanding, is where it works. It's where that kind of free lunch kind of really kicks in. My second point, all these things all follow on to each other. So if you've kind of got that in terms of my general positioning, then the rest is sort of going to follow kind of reasonably easily. So the rest is, rather than getting kind of preoccupied with stories, short-term forecasts, what the latest this, that, and the other is, and there's millions of bits of information, reports. Every time the market closes, everybody has a little story about why it went up and why. Just forget all that. The thing that, as an investment manager, you need to focus on is the asset itself and what you're being paid to take the risk. So, so FTSE 100 at the moment is a yield of 3.5%, sort of 4%. You expect that to grow a bit. So your expected return on kind of FTSE 100, 6.5% per annum. Am I happy with that? Is it enough? How does I feel about that with respect to risk? What does it look like compared to other asset classes? So just focus on what you're being paid. Have an inclination to be contrarian. Now, this is to do, again, with herding and what happens to value and expected return when prices charge up and charge down. Now, when I was like really small, somebody showed me something once that has kind of weighed with me, and I think it's a really good way of explaining something. So I'm going to do my aeroplane. Okay, so this is my aeroplane, and this is price, and this is yield. Okay, and the aeroplane kind of goes that way. Price down, your yield goes up, or it goes that way, and price goes up, and your yield comes down. Now the reason for saying that is there's a perception that if you look at a sort of a share price chart or something, or what markets have done, and it's gone up for 18 months or kind of 2 years, that looks like a good investment. And it might be. But the problem is, because that price has gone up and up and up and up, its expected return has come down and down and down and down. And the real danger is that if you're chasing things on the way up, that herd instinct, or you're panicking and knocking things out after they've gone down. The real danger is you getting whipsawed, is that you're selling things generally when their expected returns are as high as they've been for a couple of years, or you're buying things when their expected returns are as low. So, the language that I'm using here is just having an inclination to be contrarian. Kind of, sometimes things just carry on going up, and sometimes just things go. I know that, but protect yourself by just having that inclination to say, but after 2 years of going up, the yield or the expected return on this asset is going to be a lot lower. Is that sensible to be kind of piling in on the back with everybody else? Take the long view, and my first bullet on that is most don't. But they don't say that, right? So we're managing something like kind of the Prue Fund or the Scott Am Fund. You're dealing with many, many kind of fund managers, some of them within the Prue and some within Legal & General and some outside. And I've never met any kind of fund manager that doesn't say that they invest for the long term. They all say it. But if you actually look at behaviors, what actually happens, and the good evidence of this is just the actual turnover that goes on within the fund, that very few fund managers do genuinely take the longer term. And there's a whole load of infrastructure connected with how they're monitored and managed that virtually ensures that they can't. All preoccupied with kind of quarterly league tables, all preoccupied with, where they are in the kind of quartile rankings and where they are compared to the median and a little bit above or a little bit below the benchmark. That becomes a huge preoccupation. And it means that the fund manager isn't normally free to genuinely think about that kind of longer term perspective. So rather than starting getting preoccupied with all the kind of the noise and the short-term stories where all the intellectual energy is, I would say just step back from that. If you can see, and you need to be, have a good understanding of the kind of longer term issues you talk about. So, but this is where you have a chance. This is where so if the population's aging, kind of demographics, maybe that's got implications for kind of healthcare and for drugs, and let's think about that. The world of technology, and there's like big data and kind of blockchain and cybersecurity and all that. Let's have a think about those kind of things. I'm going to say a little bit about climate and climate. So that's where you have a chance, because everybody's kind of preoccupied with the next 6 months. You've got a chance if you're thinking about things over the slightly longer term. Now, in case I put this slide in because I thought everybody's just going to think that this is all motherhood and apple pie. Isn't it all really straightforward that you do kind of X, Y, and Z? But that is not what is actually happening right now at the moment. So this is an Ernst & Young survey. It's just come out. They went around all the CIOs, the chief investment officers, all the kind of big institutional money, and asked them what weighs with them in terms of when they're managing funds kind of right now. And this is the list of stuff that they've come out with. And there's absolutely nothing here about kind of demographics and kind of technology or what's it going to be like if kind of India or China become much larger parts of the world. Nothing connected with, kind of aging populations. This is all about, in the here and now, Brexit, hard, soft, what's it going to happen? What about the election? There's all this thing about trying to call the ups and downs of the cycles. When's the cycle coming to an end and when might interest rates start going up? Italy's got too much debt. They might be. And the issue about kind of the European Central is simply the head of the European Central Bank changed. So it was Draghi, became Christine Lagarde, and there was a huge intense activity and notes and loads of intellectual discussion about whether the next move in interest rates was likely to be up or down. And on the bullet at the bottom there, in my view, that is kind of largely noise for somebody that is genuinely taking a rolling 5 or 10-year view in the context of managing their money. So that's the broad framework stuff, and this is, when I use that phrase, having an edge. So where can you have an edge in the way that you think that you manage your money? And the first one here is this issue about kind of diversification, is make sure that you get, and this is our language now, SAA, your strategic asset allocation right. So this is about packaging assets up to deliver into various risk-return environments. And there's quite a good science connected with doing that. And you can have kind of backward-looking or forward-looking assumptions, and there's a whole framework for thinking. But that drives almost all of the risk and almost all of the return that you'll have in a portfolio. The other bit of the SAA that people kind of talk about is TAA, which is tactical asset allocation, and that's the dark side. That's where madness lies. I have never yet met anybody who systematically calls short-term moves in the market right. It doesn't work. And sometimes if somebody comes along and says it does. I used to work with a guy called Ted Williams, one of the fund managers, and he had a phrase, even a blind squirrel occasionally finds an acorn. So it does happen occasionally, but you can't do it consistently. Focus on long-term themes. I've talked about that. Focus on value. Now, this is my kind of airplane thing, but there are two other aspects of this that are also important. I just wanted to say something about longer-term expected returns. So in an environment, so interest rates would have been sort of like 14, 15% in the UK in sort of the late 80s or something like that. So they come down. Does anybody know what the 10-year gilt rate is, just as a matter of interest? Right? 70 basis points, okay? So it's come down, the yield has come down from 15% to 70 basis, zip, nothing. In fact, most European bond markets, they've got negative yields on. It's absolutely kind of extraordinary. So interest rates are as low as they ever have been. It's absolutely, completely extraordinary. Now, if you just think about my kind of aeroplane, okay, as kind of price goes up, kind of yields come down, your expected return on assets from this point is going to be low in the context of what you've seen. So over the last sort of 15, 20 years, you would have seen supernormal returns connected with that kind of reduction in interest rates. And from here, delivered returns from markets is going to be lower than what you've seen, probably about half. Now, this is the issue, because in real terms, that's still pretty good. You know, if you've got 6% on equities and sort of, 2.5 on a high grade, so if you've got like 50-50, 60-40 kind of in terms of your broad mix of assets, you've got, say, like sort of 4%, 4.5% expected return, which after kind of inflation, kind of 1.5 is still quite comfortable. But in absolute number, it's come down a long, long way. And my issue is costs. So if your investments are going up sort of like 14, 15% per annum, and you're paying somebody 2.5% to look after your money, in the context of the kind of returns that you're getting, it's Mickey Mouse. It doesn't matter. It's negligible. It doesn't really matter. But where your expected return is 4 to 4.5%, if somebody is still taking that kind of expense, they're taking away more than half of your expected return on the assets. And I'm very comfortable saying that because I know that the FPC kind of guys worry about that like hell and do focus on charges and costs when they're sort of selecting their fund managers. That really matters. And the other thing is tax, which is not my area, but you need to kind of make sure that there's no point generating fantastic capital gains if you've not maximized the environment in which you can take them tax-free. Right, so my game of two halves. So quickly, and I don't want to say too much about the climate thing. I just want to give you the impression that I do think it's a big deal. If I was talking to my fund manager now, right, and they started off, Brexit, this, that, the other, and we think FTSE is going to do this, and I say, whoa, just wait. The thing that I'm worried about is that if the global warming thing needs to slow down, we need to significantly reconfigure the way that we power the economy. Huge implications for oil and gas, huge implications for utilities, huge implications for the transport sector, huge implications for the built environment, how we build properties and what their kind of heating efficiency is. And the combination of all those kind of sectors is about 30 to 40% of most investment markets. Okay? So the climate thing, if we're going to do something about it, is going to have a very significant impact on some large number of sectors within the market. So, can I give you 5 minutes? Yeah, that's why I'm hearing. So, bullet points, 2 things. Transition risk. If we do something about climate change, we will need to reduce the amount of carbon that goes into the atmosphere, which means that we will need to burn less fossil fuels. Right? That's what we need to do. To get onto a trajectory where it's not really, really, really bad in 20 years' time, That's what we need to do now. And so companies connected with those sectors will either adjust or they won't adjust. And just give you a very quick picture. So I don't know, the language that's used now is there's the Paris Agreement. So we're going to try and keep kind of global warming to about kind of 1.5% kind of like going forwards. If we do that, most of the world's coal, nearly all of its oil, needs to be left in the ground. Now, we might not do that. We might, we're all growing up and we might decide not to do anything about climate change. But if we do, most of the assets within the natural resource sector, within oil and gas, are worthless. And the market has not yet got hold of that. Now, this isn't something for next, you've got to sell them a week on Tuesday or next month or something like this. It's just something to think about over the next few years. The second bullet here is that if we don't do anything about it, then the range of weather outcomes over time widens and widens and widens, and then depending on the location of your business, you've got a problem either with your insurance or the losses that you're having to incur yourself, or the government's going to have to incur on your behalf to protect, okay? And 8 out of the 10 largest cities in the world are at sea level. Let me, as I said to Maura that I wouldn't be all sort of gloomy about this, so let me just finish on kind of opportunities, because I do know, and again, this is how we're kind of thinking about it kind of now at Legal & General. We all kind of know about which kind of stuff we'd like to sell out of, but this is what we should be switching into, kind of what is going to enable the kind of transition to a lower carbon economy. So first thing is overall, around the world, about $100 trillion needs to go into renewable energy if that's going to replace the reduction in kind of the dirty stuff that's getting burned. So huge opportunities in terms of, and it's not just kind of solar and wind, there's a whole load of different kinds of ways that this could happen. But those assets need to be built, they need to be funded, and there will be expected returns and cash flows connected with them. The problem with renewable energy is intermittent, right? You only get it when the sun shines, you only get it when the wind blows. So you need batteries to support it, or some base load, so it could be nuclear or it could be something else, to generate so you can turn on when the power from the renewables isn't coming through. That's got very big implications for the stuff that you need to dig out of the ground to make batteries, and a number of big firms and sectors around the world that are involved in more advanced technologies in terms of developing them. VW have said that by 2025, 25% of their cars are going to be electric. Right? That is an absolutely phenomenal change. I think it's about half or 1% or something of new cars at the moment are electric vehicles. But VW, one of the biggest manufacturers on the planet, is going to 25%. So you can see there's a huge change within that industry. All that kit that used to be connected with the internal combustion engine needs to be gotten rid of, and we need whole loads of new stuff, and there'll be winners and losers in terms of who's going to make all the new cars in future. And finally, carbon capture and storage. There's a technology that doesn't exist yet, but it will soon. No, I don't know that. There's enough people kind of looking at it and worrying about it that are going to take carbon out of the air. That would be one of the most attractive technologies that has arisen or been around for a long, long time once we're able to do that at scale. So just have a look around which companies are kind of involved in that kind of business. So this is something that's going to sit in a chimney or sitting connected with a kind of a big heavy industrial plant, and as it's kicking out all this stuff into the atmosphere, it's going to be sucking it back out. And that technology will exist at some point, and it's really worth keeping an eye on that, because that will dramatically change the nature of businesses and the size of some of the sectors that we're investing in. So I think I've had my sort of little 5 minutes there, if not more. So thank you very much. Much appreciated.
Right, thanks, Martin. Ignore the noise, have a good plan, be prepared to trim and adjust as necessary, don't take action for the sake of it. I think some of those messages will be very familiar to people in the room, because you will have heard them from your colleagues at FPC, and think about the future, think about ESG, think about climate change, very timely. Now, time as ever is tight, but we do have time for questions from the floor. If anybody has a question, could you raise your hand in the time-honoured way and let us know? We have roving mics, so if anyone, you're all very shy. You're all very... No? Well, let me ask a question, Martin. Oh, no. Have we got a question? Sir, could you introduce yourself so we all know who you are? There's a mic on its way to you before you ask your question.
Yeah, my name is Brian McMahon. I'm a client of FPC, and I listened to you very carefully about carbon capture and FGD and all that sort of stuff.
Yeah.
I'm just wondering if what you were saying applies to the civilized world. When I say civilized, I'm talking about the likes of China, when they're opening at least one
Yes.
coal-fired power station every month, and have been doing for a long time. And we have the technology for carbon capture. Those power stations are going to run for at least another 40, 50 years, the new ones. And I was just wondering if it's different isolated areas of the world that are aware of climate change.
Yeah. So the two bits there, in terms of the problem where it currently stands, in terms of the carbon concentration in the atmosphere, that's the problem of the Western world because they've been kicking it out a lot longer. In terms of contributions to the problem now, the UK and most of the Western world is really quite small. The real issue is around China, India, and Poland. Actually, it's kind of Polish coal. That's the real problem, and that's the real problem that needs to be addressed. My sense would be that issue doesn't get addressed if we're not behaving, if we're not doing it. But I also think that we will move to a point where the West needs to support financially companies that are doing something about it, even though they're not responsible for the problem. So there will need to be some exchange of incentives at some point to encourage Poland, India, and China to stop building coal-fired power stations kind of once a week. Because that, so far as going forwards, is where the real problem is. Now, carbon capture doesn't exist at scale yet. You can do it on smaller units and smaller scale, but having something that economically you can just kind of roll out to coal-fired power stations and cement and all the other evidence, it doesn't exist. And one potential solution, and a lot of people are working at this, and there are some good things going on, if there is a solution, then that is something that can be attached to those kind of units in India and China to try and constrain the problem going forwards. But there is a big, there's an ethical conflict. So the people or the countries that are cause of the problem are telling countries that are making it worse, but not the cause of the problem, that they should be stopping. And that's, they want to say, well, this gets us out of poverty, we build more homes and schools and hospitals and roads and things like, if we're doing this, so they need to be incentivized. And how that happens, I'm not sure, but I think that's eventually what the solution will be. Sorry.
One more over there.
Sorry.
Oh,
Sorry. It's just a quick question. Philip Evans, a long-term client of the company. Listening to diversity and the investment programs and governance, what happened to Neil Woodford then? Would he not have had a team of people who would have gone through that same criteria?
Yeah, Neil Woodford, I was going to talk about Neil Woodford, but I sort of ran out of time. All the things that I was saying about taking kind of the longer term perspective and sort of not being kind of whipsawed and not just following the crowd, Neil Woodford showed those behaviors. Kind of with respect to my idea of kind of investing, 80% of the time he was hitting the right nails on the head. He was doing it right. But liquidity management, or poor liquidity management, kills you. And that's the bit that he got wrong. So within a fund, if you need to generate liquidity to give to people vesting or to pensioners, if you need cash to meet your interest requirements because you've got some borrowings, or if you need cash to meet, derivatives kind of overlay requirements, and you miss a payment, then you're dead. And Neil Wolford, even though he covered 80% of the things that I was talking, his SAA, if you like, his strategic asset allocation, didn't build enough liquidity into it for him to meet the outflows of his customers. And that was the only problem that he made, but it was the worst problem that he could have made. And it's the one that's
the index market. That was all right. That was smaller than itself.
Yeah, so within the index, so where he's investing kind of large cap, kind of liquid stocks, those assets deliver the kind of liquidity that an open-ended fund needs, even in a stress, to meet its outflows. And the problem is that Neil Wolford, having this kind of longer-term perspective and wanting to invest in unlisted companies and companies with good ideas and companies that would otherwise go to the States for funding, he wanted them to stay in the UK, instead of having 1, 2, 3, 4, 5% of his fund in there, it was much larger. And that became a real crunch as people started to leave the fund, because he could only sell the liquid stuff, which meant that the proportions in the unlisted in the residual fund went higher and higher and higher, and eventually started breaking all the rules in terms of what he could. Yeah.
We at FPC, then, we can feel quite safe with you on board and all the rest of them that the committee is looking after our interests a lot better than Neil Woodford.
Right, I'm absolutely convinced that FPC have a governance process that looks at the investment performance and their policies around liquidities before they use an investment manager. And that's because I know Mark.
Yeah. Yeah,
Right. Okay.
we will cover it later.
Okay.
One more over here on the right.
Martin,
Right.
how do you think about regulation? Is it just short-term noise in terms of your impact on expected
Regulation?
returns? Yeah, regulation.
Yeah, so there's a few things going on. In terms of, there are regulations around what kind of big insurance companies and life funds, like Legal & General, there are regulations around what they can invest in. And part of the problem with very, very low bond yields is that the regulations actively encourage large pension funds and large insurance companies to invest in very, very high-grade bonds. And the regulation there starves the country of risk capital, right? I think that's the problem there. The other problem in connection with kind of climate change, the other issue is that over the next 5 years, there will be a substantial tightening of the regulations around various industries that the market will need to respond to, and that will happen. So regulations are a given. So you go through time kind of managing money, and they're like incoming. It's just, here's another thing that you need to deal with, here's another thing that you need to deal with. But the one kind of regulation that I think substantially constrains the UK in terms of the way that it can allocate capital to develop new businesses and develop new industries is that so much institutional money is locked up in very low risk, high-grade government bonds because they have to, because the regulations require. German pension funds, for example, can't invest more than 25% in risk assets. But even like the Pru and Legal & General, it's very tightly constrained how much what they can do with their invested money. And I think that's a real problem. And we're not talking about Brexit, but if we need to make a success of Brexit, we need those industries that are going to be actively selling good products to China and India and everybody else that kind of wants to buy them, but we're not freeing up the capital to make those investments at the moment. That kind of needs to happen. And it's the regulations, I think, in part connected with pensions and Solvency II requirements for insurance companies that's causing the problem there.
Okay. If it's okay with you, I'm going to call an end to this session. Again, will you join me in thanking Martin? Thank you.